When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave, Chase, and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Welcome to the Retire Your Way podcast with Chase Lopez, ILG Financial. I'm Ron Stutz. We appreciate you joining us here today. You know, IRAs are a wonderful thing. And we're going to talk about IRAs in just a moment here, but let me tell you how you can get in touch with Chase Lopez and Dave Lopez and all the good folks at ILG Financial. Call 540-720-5656, or you can go online to ilgfinancial.com to learn a whole lot more. One more time, that phone number is 540-720-5656. As always, the show is about helping you plan for retirement and doing it in the right way. And as I mentioned, Chase, IRAs are a wonderful thing, but there are mistakes that people make every day when it comes to IRAs. And I'm talking about financial mistakes that sometimes cost them thousands and thousands of dollars. And from contributions to conversions to distributions involving IRAs, we don't want you to fall into these traps. And first of all, let me ask you about the folks who wait until the 11th hour to contribute to an IRA. How can that be a problem?
Yeah. So first of all, thank you for the intro, Ron. Always good to talk to you here on the podcast and be able to share some knowledge with the listeners here. And to your point, with IRAs, there's so many different rules and regulations and rules of thumb that a lot of people tend to follow. Sometimes people will get their financial information from TikTok, right? Someone told them on TikTok to do this with their IRA.
Not a very reliable source.
That's right. So today, really what we're trying to do is we're going to try to debunk some of those rules of thumbs and things of that nature that are out there. But as always, it's always good to get with your financial professional to see how, any of these situations could affect you. But to your point, one of the biggest myths is, hey, I'm going to wait until the 11th hour to contribute to my IRA. So that basically means, hey, I know I have to get it in by April 15th for the previous year, right? For it to count as a contribution. So I'm going to do it on April 14th, right? And that's just, sometimes people just, we do that with a lot of things in our lives, right? So it's not necessarily unique to contributing to the IRA.
Procrastination is not a good thing.
That's right. So in any event, a lot of people will wait until, the last minute. Now, why that may be not the best way to go is when you put that money into your IRA and you get it invested, right? If you get it in earlier in the year, let's say at the beginning of the year in January, as opposed to waiting until the following April, well, now you have, roughly 15 months for that extra months for that money to grow, right? So if we're waiting until the last minute, really we're, losing out on some growth opportunity there. So more often than not, it's better to kind of do it at the beginning of the year or as soon as you possibly can.
Mm-hmm. That can add up to some serious money that you've lost over time if that's what you're doing. But another mistake that people make is assuming that Roth IRA contributions are always best. I mean, Roths are great, but not always the best thing to do.
Absolutely. And there's been a big push for the Roth IRA or the Roth 401k over the last, few years. And we've done previous podcasts, and on our YouTube channel, we've done some videos about what Roth IRAs are more generally. So I'll kind of leave that out of the discussion today. But Roth IRAs is a way to save for retirement, and the growth is tax-free, right? When you take the money out, it's tax-free. The other side of that is that you pay the taxes up front. So you pay the taxes now as opposed to paying the taxes when you take the money out. Now, it takes some you want to do some planning there, because it's not always the case that you're in a lower tax bracket today than you will be in the future, right? So you want to get with your professional to see exactly what your tax situation is going to be like, because it may be more advantageous to use the traditional IRA in your specific situation. So any sort of kind of blanket advice, right, isn't always to be taken as gospel. You need to definitely get with your financial professional to see, based on your specific situation, which way the best way is to go, whether that be traditional or a Roth.
There is a common theme developing in all this conversation here, and that is the fact that, if you're trying to do everything by yourself and you do not have a professional financial person helping you along the way, you may be missing out on some opportunities, and you also could be making some big mistakes. That's why it's so important to have someone like Chase Lopez or Dave Lopez at ILG Financial to help you through the whole scenario. A lot of people make a mistake by thinking of IRA contributions as an either-or decision. And when I say that, what exactly does that mean?
So some people will think, going back to our previous conversation about the Roth and the traditional, right? They think, hey, I have to do my whole contribution into the Roth or my whole contribution into the traditional. The reality is you can split it up however you want. You could do, 60% in the Roth and 40% in the traditional, 70-30. You could do it however you really want to. So it's good to utilize both, right? Because that gives us some diversification as far as different accounts. We'll have, you'll have some money in the Roth and some money in the traditional. But it's important for folks to know that you don't have to decide to use one, and you can only use one, for that year. You can utilize both if you want to.
And all of that depends on your tax bracket today versus what it's going to be later on down the road, as you mentioned just a moment ago. Everybody has a different scenario. And, we've said thousands of times on this podcast that everybody's situation is different. And this is a good example of that.
I couldn't have said it better myself, Ron. And one thing
you could have, definitely.
But I will say, and I made the TikTok joke earlier in the podcast.
Yeah.
But a lot of these different video platforms, so TikTok, YouTube, stuff like that, some of these people, they purport, I think that's the right word, they purport to say that they know what's best for you, right? When really they're just talking to a general audience, right? And their whole goal is to create content and get more followers and things like that. Whereas if you're working with an advisor, whether it be us or somebody else, their goal is to look out for your financial future. So it's just important to kind of point that out when people are going out there and trying to get advice from sources like that.
Well, that's what being a fiduciary is all about. You always have your client's best interests at heart. Making a non-deductible IRA contribution for the long haul. That sounds great, but why could that be a problem?
Yeah, so there's a couple of reasons why this may not be the best fit for someone, and they may get, for lack of a better term, kind of painted into a corner into doing something like this.
Yeah.
And here's what I mean by that. Well, with a Roth IRA or with a traditional IRA contribution where you want to deduct the contribution off of your income tax, you want to take that deduction. Well, those have income limits, right? So if you make too much money, then you lose the ability to utilize these two tools. So what will happen is people will go above that threshold of making too much money, and they'll still contribute, they'll still put money into their traditional IRA. Right. Now, as the money grows inside of that traditional IRA, it's still growing tax deferred, but you didn't get the deduction up front. So there's a couple of wrinkles or flies in the ointment that causes. The first is you have to keep track manually. Your Charles Schwab account or your Fidelity account won't keep track of it for you, but you have to manually keep track of how much money you put in that was not deductible and how much it's grown over the years. So that creates a lot of extra work and extra headache for folks, just the tracking of all of that manually. And then to boot, if you don't track all of it, then down the line when you take money out from that tax deferred account, you could basically be paying double tax on some of that money. So, it's not really A lot of people will do it because there's things called a backdoor Roth conversion and things like that. But those are very unique strategies that should be used, that should definitely be vetted before you start kind of doing that stuff on your own.
Chase, here on the Retire Your Way podcast, we have talked in the past about backdoor Roth IRAs. And why can it be a problem if you assume that a backdoor Roth IRA is going to be tax-free?
So the Roth IRA, it has some specific, rules. Yeah, I guess for kind of a lack of a better term. They have rules in there that the Roth IRA has to be open for 5 years, right? Yeah. And then the money has to go, when it goes in, right, it has kind of a 5-year clock. And, before I get a little deeper into that, each person's situation with the Roths is a little bit different, because if you start a Roth very early in your life, then your 5-year clock is kind of over. But if you're opening up a new Roth, there's kind of a 5-year clock on, making that money inside tax-free. So if you don't end up waiting on that 5-year clock, well, then now when you take the money out of your Roth IRA, the gains on that is going to be taxable, and that can create some tax headaches, down the line. And quite frankly, you're not really using the Roth the way it's supposed to be used. So it can create some issues there if you're not fully aware of all of the rules with, Roth IRA and how that translates.
You mentioned taking a dive into the rules and regulations and all that kind of thing. Good opportunity for me to point out that when folks talk to you, you'll be glad to take a deeper dive into all this stuff. And we're doing all this for the sake of the podcast to get some good information out there. But if you want to take a deeper dive into one of the aspects of our conversation here, you can certainly do that. We're down to, I think, number 6 on our list here of things having to do with IRAs and mistakes that people can make. Another one is assuming a backdoor Roth IRA is off limits because of substantial traditional IRA assets.
That's exactly right. So the backdoor Roth conversion, backdoor Roth IRA, Roth conversion is a unique strategy that people that make above those thresholds that we were talking about before can utilize to get more money into the tax-free bucket, that Roth IRA bucket. There are some limitations as far as how much you can do when you're doing a strategy like that. So a strategy within the strategy, I guess, is you could utilize your current 401k to assist with some of this backdoor Roth, strategies. Again, the backdoor Roth strategy is a strategy that's used by a very small number of people out there. So if you think it might be a good fit, to kind of piggyback what you said earlier, I would definitely reach out to either myself or your financial professional to see how it would kind of affect your specific situation. But it is a good strategy for high-earning folks to get money into those tax-free buckets, the Roth IRA buckets.
Yeah. There are so many rules and regulations, as you pointed out, and you have to be careful if you're doing all this stuff yourself. But with ILG Financial, Chase Lopez and Dave Lopez, they know all these rules and regulations, and they're going to make sure that you do the right thing for you. Now, number 7 on our list about mistakes that people can make with IRAs, not contributing to an IRA later in life. Now, take a moment and explain that one, if you would.
Yeah, absolutely. So sometimes we'll meet with folks, and they'll say, they'll say, oh man, I haven't, saved, and they're getting closer to retirement, and they'll say, man, it's just too late, right? At this point, I'm not even gonna start, right? I haven't saved up until this point. I'm just going to be working forever, so on and so forth. There's actually, and this is not necessarily exactly related to Roth IRAs and IRAs and things of that nature, but there's this old, I believe it's a Chinese proverb, but don't quote me, Ron. But it's this old saying that says, the best day to plant a tree was 20 years ago. The next best day is today, right? Yeah. So exactly. It's never too late to start, saving for retirement and contributing to this IRA. But as you get older, they have there's a rule that's called a catch-up provision And it basically is a rule that allows folks that are getting close to retirement to save even more for retirement. So your limits that you can contribute are actually increased. As of this recording, we're in the year 2024. So right now the limit is $7,000. But if you're above age 55, you can actually contribute $8,000. It's what they call a catch-up. So the government acknowledges, hey, even if you haven't saved, it's never kind of too late. So they kind of give you a little bit more access to the Roth IRA and the IRA by allowing you to contribute more to those accounts for retirement.
Yeah. We're talking about various mistakes that people can make with IRAs here on the Retire Your Way podcast. Again, if you want to have a longer conversation about any of this stuff with Chase or Dave, call 540-720-5656. A lot of people forget all about spousal IRA contributions, and we've talked about that many times on this podcast. Explain that, if you would. Take just a moment here and go over that.
Yeah, so this is really a lost opportunity for a lot of households, a lot of clients that we meet with. Sometimes, not always, but sometimes with a couple, one spouse will be working, right? And one spouse maybe isn't working because they're, helping out with the kids, helping out with the grandkids, whatever the case may be. But even if your spouse isn't working, they can still contribute to a Roth IRA or an IRA, even though they're not working. It's called the spousal IRA contribution. You kind of led with that. So every year they have that opportunity. So you definitely don't want to, miss out on that opportunity. Think about this. If your spouse isn't working for 10 or 15 years and you had the ability to, contribute to this Roth IRA or this IRA, and let's use that $7,000 number as just a general number, right? Well, over 10 years, that's $70,000 you could have contributed to an IRA in your spouse's name. But, you lost that opportunity because you just weren't aware that was an option. So very important for folks to know that even if the spouse isn't working, they still can, contribute to an IRA.
Some folks delay their IRA contributions because of short-term considerations. And when I say that, what do I mean by that?
Yeah. So, as you know, Ron, life, it's always happening, right? There's always something, right?
Life happens while you're making other plans is what
that's it.
One saying. Yes, I think that's was John Lennon who said that.
That's right. So with that, the easy thing for a lot of people to do, oh man, this came up, I'll just take this year off from contributing to the IRA or the Roth IRA, right? Mm-hmm. And the reality is, and you said it best, the reality is there's always something, right? There's always something that comes up, whether that be something you need to do or something you want to do, right? You want the new car, you want to go on that vacation. But it's very important, especially for folks that are just getting started saving, to really try to stay very disciplined with those contributions to those retirement accounts, because the more time you have in front of you, the more time that money has to grow. So we all have things that kind of come up, but even if it's $25, $50 a month that you can put in there, try to stick to it, because in the long run, that's really going to serve you well once you get to retirement age.
Well, let's talk about one more on this edition of the Retire Your Way podcast. We're talking about mistakes that people make with IRAs. And, we always want to make sure that everybody does everything legally. And, some people break the rules and regulations because they simply don't know. You can run afoul of the Roth IRA 5-year rule. And for the folks who don't know, what is that all about?
Yeah, so I kind of alluded to it a little bit earlier here in the podcast, but the Roth IRAs have what's called a 5-year rule. And basically what that says is your ability to take advantage of the tax-free withdrawals from the IRA, which is really the biggest advantage of utilizing one. There is a 5-year rule, meaning that the assets must be in the Roth for at least 5 years before you can begin withdrawing them. Now, I know that sounds pretty straightforward, but it can get a little complicated when you're doing conversions from your traditional IRA to your Roth IRA. So before you take that withdrawal and before you assume, hey, I'm taking it out of my Roth, so it must be tax-free, definitely get with your financial professional and just run it by them to say, hey, I'm thinking about taking money out of this Roth. I want to make sure I have all my I's dotted and all my T's crossed so that I don't get a big tax bill in April.
Yeah. Another reason to get in touch with Chase and talk more about that. And Chase, I love going through all this stuff because you have the ability to break it down for all of us to understand all these things. And we're going to have another podcast coming up soon with some more mistakes that people make when it comes to IRAs. But I guess it's time to close out this segment of the Retire Your Way podcast. And I look forward to that conversation in the future, as always. By the way, if you'd like to get in touch with Dave Lopez or Chase Lopez, the folks at ILG Financial, go to 540-720-5656. That is 540-720-5656. Or simply go to ilgfinancial.com to learn a whole lot more. This has been the Retire Your Way podcast with Chase Lopez. I'm Ron Stutz. Thanks for listening. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, a registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.